Hey everyone, time for another market update. So it is the last month of the year, and what a year it has been. So let's take a moment to reflect back on what has gotten us to this point and what I expect we might see in 2023. So looking ahead to next year, I don't think that we're going to see rates go much higher. Every economist I follow is saying the same thing, which is that rates are likely to level off. In fact, we're probably going to see some softening in the form of lower interest rates probably sometime around Q2 or Q3 of next year. I don't think we're going to see rates go back down to the fours, but I think it is likely we'll see rates in the fives next year. Now, a lot of people are sitting on the sidelines waiting for prices to drop, and the reality is they might be sitting there for a while. Even though there are fewer buyers in the market as a result of higher interest rates, there's even fewer amounts of inventory as a result of the fact that the vast majority of homeowners refinanced in the last couple of years into historically low interest rates. In fact, it's estimated that 35 to 40% of existing homeowners refinanced in the last 24 months, which means they're sitting on an incredibly low, comfortable monthly payment. So unless there's a life event that necessitates that they sell, they're probably going to be inclined to sit tight for a little while and ride this out. What does all this mean? Well, it means that there's probably not going to be very much inventory in the months ahead. So what happens when there's less of any commodity? Its value goes up. Or in this case, it probably stabilizes. It's called scarcity. This isn't a housing bubble, and it isn't a housing recession, and it certainly isn't a housing crisis. This is a housing reversion and a housing stabilization. You have to remember the last 2 years were an anomaly. They weren't real. We are likely never going to see that same confluence of events ever again in our history. The world got hit with a global pandemic pushing interest rates to the lowest levels we've ever seen in history. Now, you couple that with a backlog supply chain, and what you get is the highest inflation we've seen in 40 years. Now, I'm oversimplifying this, of course, but I'm trying to keep this brief for the sake of time. As the saying goes, this too shall pass. Markets are cyclical, and this one is going through a long overdue adjustment. Keep an eye on the key indicators, though. For example, foreclosure rates aren't even at 0.1% for what they were in 2008. Homeowners are sitting on more equity than they ever have at any time in history. Unemployment remains very low. Lending standards continue to remain some of their strictest and highest we've ever seen. This is not a doom and gloom day scenario. This is a long overdue adjustment to an overinflated market. Stay tuned in the coming year for more updates and insights. I wish everyone a very happy holiday season, and I look forward to speaking with you again soon.